TCAP program. The exchange program is now called the Section 1602 program, as Treasury has told us last week. I'm just going to run through these bullets very quickly, but there are things that came out in the guidance that came out last week that really surprised a lot of us and upset us in some cases, and we're going to try to go through that as well. And I think we might a little bit, we don't want to take too much time with this because there's a lot of other information, but some of these we may want to stop and talk about for a minute. I heard the accountants and the lawyers out in the hallway talking about some of the implications that I certainly hadn't thought about of where HUD and Treasury seem to be going with their guidance. So if you look at the exchange legislation first, this one obviously is administered by Treasury and the IRS. It's for only 2009 credits for those that are returned or unused, per capita credits and national pool credits. You can't be for 2008 credit projects. You have to actually return the credits and put them into the 2009 pool. And they're exchanged at 85 cents on the dollar. We all know that. 100% of any prior year's credits returned during 2009, any unused credits can be exchanged. So 100% for those. The returned ones that go back become 2009 credits, and unused, which most states didn't have, I don't think. And then 40% of the 2009 per capita and any national pool credits that a state gets can be exchanged. And the funds are to be awarded to projects as grants, and the grants don't reduce eligible basis, and they are not taxable income from the federal perspective, right? Because they were talking about it in the hallway that it could be that they could be income for tax for state purposes. They could be taxed. So that becomes a big complication for developers who receive this income. And some states will require it, and some states won't, and some states may want to try and change so they can increase their reserves. And the other big surprise about this is that they are currently, the IRS is currently, Treasury is currently saying that these cannot be loans. And that was a bit of a surprise. The legislation doesn't really say that, although it does talk about grants and subawards. So the IRS right now at this point is just saying they cannot be loans, except although I think they might be able to be forgivable loans, but it ends up being the same thing, I think, in that case. So that was a surprise and something I think people are going to be working on a little bit too. I know the states in particular are very much wanting these to be loans in most cases. The funds can be used for projects with and without allocations, and that's really not too defined, but that could mean bond deals. They don't actually get allocations, and maybe perhaps other kinds of deals as well. Those allocated credits have to show good faith effort to find an investor, and the states have to define what that means and have proof that they have tried and have been unable to find an investor before they can exchange their credits for cash. Section 42 governs as to income, as to wards in general, which is probably alluding to the QAP and all of its requirements in it, but including Section 4 income rent restrictions. The funds not used to make subawards before January 1st, 2011 are returned on or after any recaptured credits go back to the Treasury. Another surprise that came out of the guidance is that now the Treasury is saying that you actually have to, state agencies have to have dispersed those funds and not just awarded them or used them as the language is in the legislation. It's a big difference because you may have a project that isn't completed, you've awarded it the amount of money it's going to get, but you haven't dispersed it because you can only disperse both in this program and the other program based on draws. You have to incur your costs as a developer, you have to submit just like a construction loan, and then they reimburse you. And they only have 3 days. When they receive the money, they have 3 days to get it out to the developer. So it's sort of a weird and difficult process that they're putting us through. But again, I think we're going to go back and fight the dispersed language very strongly because we do not believe that's what it meant. But for the time being, it makes a big crimp in anyone's plans to how to get these credits out. The agencies have to do asset management functions or contract them out for compliance with Section 42 and for long-term viability. And that sort of indicates that not only do agencies do what they normally do, which is review the projects every 3 years or 5 years, whatever the rule is, but they're going to have to be looking at financial statements, rent increases, and all those things that maintain a project's viability over the long term. Agencies must impose conditions and restrictions, including recapture, to ensure it remains a low-income project during the compliance period. And agencies can collect reasonable fees, but the fees cannot come out of the exchange money. They have to be paid separately, although it's all fungible in the end. The legislation does not require adherence to the federally appropriated program requirements such as Davis-Bacon, NEPA, and those sorts of things. So it's a real benefit on that side of the program, on the exchange, not to have to do those kinds of expensive requirements and time-consuming requirements. A couple other things that are not on here that have come out in the guidance. The agencies actually, so they submit their applications for the exchange money, Treasury approves them, and then Treasury will make the funds available in draws, as I said, and only as needed. So again, they can't just give them a lump sum like you might do at, like we do with our equity, and put 30% in at closing and let them spend that through the construction period, through the construction lender. Can't do that. It has to be on draws. The reporting requirements are pretty onerous. They're quarterly, and there's a lot of information that has to be included, including how many jobs have been retained, created, construction jobs, and administrative jobs, same thing, along with a bunch of other information. So it's going to be a lot of work, because they have to report to the Treasury this way, and then there's another reporting requirement on the HUD side. So there's a lot of administrative work to be done in a very timely fashion, or you get in trouble. And you don't want to get in trouble with the IRS, because they know where you are. And finally, there's a financial management requirement where you really have to account for the funds, and that, again, you don't want to get in trouble with the IRS and how the agency accounts, which means the developers are going to have to account for how they're spending the money, which will come down through the draws. If there's a process set up, it'll be probably pretty transparent. So that's sort of what the exchange legislation
Ron, you want to take questions?
is about. Yeah, is there any comments or questions at this point?
Ron, do you know what the effort is in terms of trying to reverse this Treasury concept that the money's got to come in as a grant? That has a pretty dire consequences in California through the prevailing wage.
Well, it hasn't been proved to me yet that that's the result in California, that it would require prevailing wage.
Okay. I was discussing the DIR on Friday.
Right. Right. Well, and it could be, and that would be really dire, because then it would give you the same problems as you have with the TCAP, basically, on the Davis-Bacon prevailing wage side. I don't know. These just came out on May 3rd, so we're certainly the coalition at the national level will be making comments on this. I know other people have already contacted Treasury. We just need to go at them and show them where they're wrong, and explain to them that there's really no harm in doing it the other way. Although any money that's taken back, if you used to have a 1% interest on your loan and agency actually gets some, it all goes back to the Treasury. So it's really not about the money that an agency can get. It's more about, I think, the control and feeling a little more comfortable on the recapture side, that with a loan you've got more of a hook. So there's one over here first, then Ken.
When the credits are returned, do they automatically go to the national pool? And then my second part of the question is, when the credits are returned, do they automatically go back to the national pool? Second part is, can you also use Capp with the exchange?
The money goes back to Treasury. There's no money that stays, different from the TCAP, from the HUD side. This money goes back to the Treasury. And it's unclear if you can mix them or not. Many think that you can, but now as we're getting this guidance, it's looking a little bit more to me, when you go back and look at the legislation and sort of see where this guidance is going, that it really was the intent, the exchange money be used in lieu of tax credits. So it almost sounds like maybe that's what they really meant, is that you trade it in at 85 cents, you get whatever the state gives you, and that's what you use to fund your project along with your permanent loans, soft loans, whatever else is in there. And the TCAP would be used, the way the language sort of states it, is additional to fund gaps. So it's a little unclear as you start to see this guidance come out that maybe they're not really thinking that's the case, and that TCAP shouldn't be used to fund an entire project, that maybe it should really be used only in